Hi, good afternoon. Welcome to VCTV with me, Luke Sullivan. I'm here today with Raghu, Gary, and Adrian. And today we are talking about, is equity the new currency? So first and foremost, guys, and Adrian, I'd just like to thank you for coming on today. Firstly, if we could just go around, if you could just introduce yourselves very quickly, let our listeners and viewers know who you are and what you're about. And if we can start with Raghu.
Thank you, Luke. Thanks to VCTV. I always enjoy these shows. I'm Raghu Rao from Princeton, New Jersey, a serial entrepreneur, investor, and advisor, and specialize in early stage de-risked impact investments. And early stage, of course, equity has always been the currency, and look forward to the discussion.
Brilliant. Lovely to have you on, Raghu. I'm going to go to Gary now. Gary, you good?
Sure. I'm always good. My name's Gary Fowler. I'm a serial entrepreneur and investor. I've done 17 startups. I've been involved in 2 unicorns. I was on the original management team of Click Software, which was sold to Salesforce for $1.35 billion, and also Eva.ai, an AI HR tech company that I co-founded with Dr. David Zhang. Love artificial intelligence in quantum computing. In fact, my 161st article is coming out today in Forbes magazine on replicating humans using artificial intelligence. I believe that intellectual capacity is evenly spread around the world and opportunity isn't. That's why I co-founded GSD, Get You Done Venture Studios, a premier AI and quantum venture studio located in Silicon Valley that curates companies from all over the world and helps them go global using Silicon Valley support. We are currently in 24 countries worldwide.
Thank you for that, Gary. It's a real pleasure to have you here today as well. It sounds like you're in some really, really interesting projects there. Adrian, lovely to meet you today. Please tell us who you are and what you're about.
Thank you very much for having me here today, and let's have a warm welcome to Luke to the VCTV family, because I believe it is the first day for you.
It is, yeah, my first show.
To be the first out of the many, I want to thank for the opportunity to be here. I'm Adrian Niculescu, serial entrepreneur and investor. I'm involved in few projects: CloudCoin Consortium, blockchain digital currency, DAO1, a decentralized autonomous organization. Also, I'm involved in building coincruncher.com, which is a news and education resource for everything blockchain, DeFi, and NFT. Also, I'm working in venture capital world as a venture partner for End Ventures, a Singapore-based early stage fund. And also I work since 2014 with Faster Capital, which is a Dubai-based accelerator and incubator for startups. It's an amazing topic today because the currency at the beginning of startups is usually equity.
Brilliant. Thank you for that, Adrian. And what a lovely introduction for myself from you as well. Thank you so much.
You're welcome.
To all of our regular viewers, I am a new face. This will be the first time you've seen me. To people who this is your first time, I'm like the furniture, I've always been here. So today we're going to be talking about, is equity the new currency? So the question is equity the new currency? And what does that mean to investors? I think, Adrian, you were leading into this really nicely with startups. What do you think?
I'm involved in a lot of early stage startups, either helping them to get financing or becoming an advisor or helping them in a certain way with few connections. And usually there is a team of founders. And we've discussed in the previous show where the host was Gary, that the sweet spot for having a founding team is 3 people. And usually when they start hiring, because at the beginning, usually the startups, they don't have a lot of money, they are able to hire people who will share the same vision and are ready to come on board for very to little no money usually, but with an equity stake in the future success of that company, and the project is kick-started. Next, of course, some projects can start to have a revenue depending on what they are creating, or they rely exclusively on getting money from investors to be able to advance. And of course, the investors will invest in the equity of that company. The exceptions today are the startups which are issuing also some tokens, and besides equity investments, they are able to sell tokens. This space is not regulated yet, but there are various ways today to bring an early stage startup, and equity is very, very important from day one. And just to close this idea, the earliest you are giving equity, especially to investors, you will get less money for giving more equity. If you are able to finance yourself in another way, either to sales or to tokens or to other ways, you will be able later, once you start having revenue, to get more money from investors for a lower percentage in equity. So there are no universal solutions. You need to see which ones will work for your startup.
Thank you for that. I think it goes back nicely to the story about the person who painted the Facebook offices, who got paid in shares, and they're now worth multi-millions. What's your thoughts on the topic, Gary?
Yeah, so I mean, hi, Peter. Good morning. Good afternoon.
Good morning. How are you guys?
Hi, buddy.
Raghu, how are
Very
you?
well.
Adrian, how are you? Sorry, I'm a bit
We were
late.
waiting for you. We
know each other, right? We've been on sometimes hundreds of shows together, so we know each other. It's like a family hour here, you know? Anyhow, so, I mean, you're right about the painter. He got 250 million shares of stock. My office is in Silicon Valley in Palo Alto, so you see it a lot. I mean, it's the way I've seen people go from 0 to $30 million in value just because they had equity in a company. So it's a great tool. The problem is many cultures don't understand the value of equity. They think just about the check. They don't think about equity. And so one of the challenges is really educating them. If you look at it, and things like employee stock pools should be anywhere from 15 to 20% allocated. And some companies, I opened up the first accelerator in Russia, spoke of a startup academy, and also the top private corporate accelerator there. And one of the things that we've seen is that the CEOs of the companies don't want to give up equity. And, so we've got kind of mixed cultural views. You got to find the cultures. You got to educate to show what the value of having the equity is, because you want everybody to partake in the success of the company and create a really interesting opportunity for everybody and buy-in. So is it the new currency? I mean, in Silicon Valley, it's been like this forever. I mean, it hasn't really been, I'm not sure it ever, we just don't even discuss it, to be honest with you. If you don't get equity, you ain't in the game. You're not going to get the best people, because they do. I look at it as kind of like surfing. They surf from company to company. And, I remember during the .com stuff, and I was involved in it, right? So they would surf. They would go from Broadvision, and P. Hong, my friend, if you're listening, hi. They would go from Broadvision to Ariba to Salesforce. I mean, and surf around because they would get the equity, hit the right company at the right time, and that's how that was a retirement plan, right? So that was they get a money as a salary, sometimes a little bit lower than normal, but the upside is to get to equity, and that's really important. But then, how's the equity given? What's the vesting schedule of the equity? What happens? Is there a liquidity event? Does it accelerate? These are some of the questions you got to ask. It's not just, is it the new currency? It's been in the Valley, since day one. But the situation is, when do you get it and how?
Thanks for that. I think you've just highlighted the fact that, when we have skin in the game, it creates a lot more value for us. Peter, thank you for joining the call. My name's Luke. We've not met before. It's a pleasure to meet you. I'm going to ask the question to Raghu, and then I'll just come back to you if that's okay. So Raghu, the question, is equity the new currency? And what does that mean for investors?
Yeah, I agree with Gary that equity has always been the new currency. I mean, always been the currency in the tech world. See, there is a paradigm. There is the cultural paradigms which are different. Wall Street is on bonus, and the tech part is on equity, right? And now it's becoming global. There are some cultures, as Gary mentioned, Middle East, India, and which are very conservative and do not quite have that equity model. But it's happening now because there are. Entrepreneurship is going global, and I think it's very, very appropriate because the team, the initial team, if it has the vision to build the big company, they should be compensated appropriately. It's not just. I mean, the big company model of the CEO happens later. It's really the vision, and you have seen that the scale-ups that are happening, especially now with the pandemic, accelerating technology acceptance. I mean, for a while in there. Things were kind of stalled, and now I think many technologies that would not have happened but for the pandemic are now really been accelerated. So I think it's always been there, but I think it has now become skewed a little bit more towards the equity than the bonus, I would say.
It's interesting you mentioned bonus because Wall Street has been big on bonuses for a long time, and they're very, withholding to change. So the fact that the IT industry is moving equity forward as a reward system is interesting and something that, I wonder if Wall Street will adopt one day. Peter, lovely to meet you. Before we ask you the question, can you just give our viewers a quick 30-second breakdown who you are and what you do, please?
Absolutely. So, thanks, Luke. It's great to be here. Raghu and Gary are old friends. I've seen Adrian on the show before. Again, thanks so much. Sorry, took it a little while to get on today. Always having some technical problems. I'm a bit retarded when it comes to that. In any event, I sit at a five-family, multi-billion-dollar family office here in London. Our family office is based in London and Denmark. I have a strange accent. Doesn't sound like a Brit because I'm from New York. So that's in different English language to begin with. But we focus on investments around the world in various asset classes. Real estate is our core, but I'm an engineer by background and computer science major as well. So I do know the space, and Gary and I and his partner, Derek, are involved in a bunch of interesting things together. What I'd have to say in terms of this topic, I thought it's an interesting topic, but from your viewers' point of view and from me, I've been an investment banker, a research geek, family office, running a family office for a while, portfolio manager. So I think I can comment across the capital stack. And I would just simply say equity is the most expensive form of capital that exists. The cheapest form of capital is senior debt, obviously, but it's very difficult for a startup company or even just some guys sitting in a garage with an idea to raise debt financing. One, they probably don't have the assets to attribute to that, or the bankers aren't intelligent enough to ascribe a proper valuation, particularly if it's intellectual property, copyrights, et cetera, patent technology that might not show true cash flowing for several years. But when you get into the more higher yielding entities and the lower quality type of credit, that basically is with not a lot of cash flows or even negative cash flows. We call that high yield investments. So bankers and people like myself are still able to attract a tribe of value to a company that's not performing cash flows for several years, but then we'll have an uptick to it. So as long as there's something to secure, intellectual property, physical assets, or otherwise, there is the possibility of bringing debt into the equation. You wouldn't want to bring debt on early on because there's a cash flow drain. That interest needs to be serviced. Now, you can get creative. We could basically pick that interest or accumulate that interest for 4 or 5 years until the company is generating cash flow, and then have those cash flow payments, those cash flow going earmarked towards interest payments. But I believe that there's got to be at some point in the stage of a company, once it starts getting going, some type of debt and equity in the capital structure. Because when you have too much equity, it's dilutive, not just the initial owners and the founders, but it also to the employees as well as the future investors into the company, as the initial ones get diluted, and then there's just more capital that's outstanding there. So a healthy balance at some stage of debt versus equity is important to reduce that dilution. I said there's ways to be structuring that so that it is not a drain on cash flow. But at the very simple stage, the best way to start off maybe is if you have a company and it's past the initial seed rounds and stuff, basically not just rewarding stock and warrants, because warrants options obviously are dilutive at some point as well, but maybe going into a format where there is going to be some portion of equity incentive, but also some sort of, and that could be non-dilutive equity too, depends on how it's structured, but also maybe in a cash bonus payment at some stage, even if it's not very small in the first 12 months, maybe it grows exponentially over the years that the company starts to generate cash. Maybe that cash bonus is tied to hitting certain milestones in terms of the performance of the company, either key metrics or key deliverables in the company. So you have a combination of equity, and you have a combination, and that equity maybe again is can't be sold right away, so it's not as dilutive to existing investors. And then a possibility for a cash bonus. So I think we need to be more creative when we're talking about venture capital in terms of how the incentive structure works for employees, because everybody's not just going to get a big bunch of stock and everybody's going to be a billionaire, right? So you want to have a nice, healthy mix. And I think that happens when the initial company that has its first or second round then starts to get a little more mature and having a much more mature type of capital stack and rewards compensation package.
Thanks for that. That was really interesting. One thing you kept going on about mentioning was debt. We all know how important debt is with financial markets. Leads me really nicely on to my next question, and that was, I mean, you guys have been involved with startups. You've seen, you know, I can imagine a lot of people hit successful streaks, you know, become very successful overnight. Do you think that when we look at equity as a form of currency, and when people achieve success overnight, do you think this changes the way that they see and interact with traditional markets? And I'm going to go to Raghu for this.
They do. I think in the early stage, customer traction is always the best thing, right? And otherwise your equity is just a piece of paper. So until the valuation is actually validated by the customers and other investors and everything. So the equity is only, I mean, it's, as they say, 0 of 0 is 0. So you have to create value. So at some point, people realize that. I think especially the serial entrepreneurs understand that it's not just about how much equity you have, what is it worth, So that, I think the customer traction is very important. There are also different models here. There's a so-called hyper growth model where, pre-revenue, it hits like a unicorn, in terms of valuation. So those, I mean, of course, usually they're serial entrepreneurs, or you hit something, that goes viral. It's hard to plan for that, although a lot of people claim that they're going to be unicorns. It doesn't just happen. So I think it is important to be grounded. Customer traction is very, very important. And the MVP needs to be, use something like design thinking or something so that the customer needs are met and addressed in your product, not just you build something and it'll happen, right? That's my perspective.
I think we all think that our ideas are unicorns, don't we? I think we all think our ideas are the best ones, and if we didn't, I don't think we'd care about them much. Gary, what do you think about this?
Well, I think one thing that we all think that our ideas are unicorns. Many people think, but you remember one thing, Luke: unicorns are mythical creatures; they don't exist. So you believe in something that's not real to begin with. So think about that. Doesn't make much sense, does it? All I believe in is getting shit done, right? And that's the name of our company. because it's about the execution. It's about getting shit done, moving forward, using customer development, validating your product. I can tell you when we did EVA, my company, I pivoted the company 3 times. My partner is a billionaire, Dr. David Yang. When it first came out, we did a Google-like search for the personal cloud. People weren't ready for it. Pivoted to a smart assistant. Google gives it for free. And then I went to using the same technology, moved over to HR and remote workforce management, and a hit. So what I can tell you is that as you're going down through this process, it's very important if you're going to build your equity up, because I mean, you can get equity. Remember, 100% of nothing is still zero, right? So it's a matter of, can you create value? And what you want to do is you want to make sure your team is all on the same page, right? One of the things I do, and I'm sure members of my team are listening or going to listen to this, but one of the things that we do is we make everything fair. We have a very level playing field, right? We're all on the same page. We all got to work hard. We all got to make sure we're contributing, and there's no slackers, right? We're in to win. So that's part of it. And building that kind of a culture, leading the company in the kind of way to be able to create that's critically important. And there's a lot of pieces to the puzzle for that, which is another show. But the net is you have to go down through and create it. Now, it's interesting because if you look at serial entrepreneurs, they've had many of them have had success after success after success. Why? Because they know how to attract the right team, and they know how to be able to pivot their ideas to make sure it's a winner. So anyhow, it's a great opportunity. Equity, as I said, in around the world, we deal a lot in Africa. Equity is critically important. Everybody's got to share in the success of the company. It's not just about a check. And we can see that evolution taking place, although, you know, in the Valley, it's the key is it's not just the equity, it's also making sure that you're getting enough money to be able to feed your family. Early stage startups, it's kind of difficult. So you look at different kind of people. You look at people that have some money, that are willing to, you know, come in to put some skin in the game, or make less money. But then the situation, everybody needs to partake as a company starts to grow.
Thanks. There was a lot of wisdom in that answer, and I'm going to have to re-watch it just to catch every single point on that, Gary. I really appreciate it. Peter, what do you think?
Listen, I echo Raghu and Gary's comments. I really don't have a lot more to add. But I do think that there's a larger conversation here that needs to take place. And that's a conversation of efficient capital structures once a company starts to have, after it has its initial round of funding, and then a better alignment of rewards for both the employees that are dedicated to building something very special along the journey, but then existing investors as well, to making sure that everybody shares in the rewards without having a significant dilution. I don't think capital in the form of debt is something that should be placed at the beginning or early stage of any company. They just can't afford it. But like I said, after we get a couple of years into it and you have a visible pipeline of cash flows at some point, we can start talking about a more structured approach where we can manage the capital structure more efficiently. Remember, people just think we get equity and that's cheap because there's no coupon attached, there's no cash flow implication. So that's got to be the cheapest form of capital. It's not. Equity is the most expensive part of capital. There's a reason why. It's also the most risky form of capital because it's a binary outcome. You can get zero or you can get multiple upside. And you can also lose. So it's a very risky form of the capital stack. There's no protection. There's no security. You have no interest. You are an owner of the business, but you don't have security against any of the assets, intellectual property, physical assets, or otherwise. And thus, since you're taking that type of risk, whether you're an employee or an investor, obviously you need to be cognizant and be paid for the risk that you're taking. But there's also got to be a more equitable distribution of that wealth once a company starts to mature and everybody becomes a key part of the capital stack, and be cognizant of that capital stack in terms of how it's going to impact the company and its key shareholders.
Thanks, Peter. As Adrian, what do you think?
You're on mute, Adrian.
You see this discussion, thank you very much, Gary. It's like a mini MBA on this topic. And we people are usually wired for short-term gains. So we say we want a higher salary right now. We are not able to think that we need to put, let's say, a part of that salary in some equity, which will delay the gratification for a few years. But when the gratification will come, if the project will be successful, so the work is always first, will be a huge celebration. And it's a mindset shift. And I said mini MBA because if you look at the commercials, they don't say you need to train 2 years to go to the gym. They say it's a cure over the weekend to lose 10 kilos. You don't need to go to the gym. Just do this 7 minutes, 3 days, and you will have six-pack abs. Or why going to an MBA for 2 years when you can go to a weekend mini MBA type of course, and you will learn the same thing? Here in the call, you have a lot of ideas, but you need to do a lot of research in order to implement. And action is everything. But in the startup world, exactly this delayed gratification and having the skin in the game, but allowing you to earn less right now, but to build your equity stake, which will mean something huge if the project will be successful, if the project will go to future investment rounds, or if it will go public or it will be an exit. This means that you are ready with your mind to put an effort which could last for years without thinking about the fact that, okay, that gratification will come sometime, because you will be focusing on building that project. And is a huge mindset shift for most people. But once you are able to do this shift, and of course it's important over this process to be able to provide for your family, and this is very, very important, then you are accessing that mojo you write about in the magazine. But sometimes it takes a while, because I said we are wired for the short-term gratification, which is a trap, because we'll keep those opportunities far away from you.
Thanks. You raised some really good points there. One thing that did get me thinking about is, holding equity versus cash in the bank. We now have employees starting to think like investors about, will I offset my time for future rewards? And I personally think that we're seeing a shift in mindset towards finance and equity and returns on the investment, which really leads me nicely onto this question, which is the juicy one here for me, and the one that I'm really interested to hear what you guys think about, because I believe that we're moving towards a new financial system. What are your thoughts on it? And what would be on your wish list? What would you like to see implemented that you think is broken currently? And as you've got your eyes so firmly on the future, Gary, I'd like to start with you on this one, please.
Yeah, so I've just written an article, my last article in Forbes, not the article that's coming out today, but the previous article talked about how we're going to have loyalty-based tokens, how we're going to base tokens are going to be based on, what the value of the connections are, what the value that you put in it, get it paid basically for your effort. And so if you look at how we've changed, think about this. Intellectual capacity is evenly spread around the world, but opportunities aren't. One of the things we've learned over the last 2 years is that during this COVID crisis is that we need to digitally transform as a world. We need to level the playing field and give others equal opportunity to be able to participate, whether it's in work or play or the financial system. One of the things we're going to see, and we saw this during, I was deeply involved in the e-commerce back in the late 90s, started one of the first e-commerce consulting companies working with Walmart and some of the top companies around the planet. But one of the things we saw is a transition take place then. Now, as we're moving to this 4.0 environment, we're seeing another transition take place, which is, of course, governments are concerned, central banks are concerned because they can't really control it if they have these cryptocurrencies out in the marketplace, and now the tokenization of everything. But it's going to happen because we got to put value on things, and we haven't done that before. Assigning the right kind of value, a correct value for like a model that really rewards you. And that's the next evolution that I see. And I see these systems being global. I don't see them being regional. I see governments that have currently put up some roadblocks going to have to open the doors because everybody's going to have to participate. They'll force it. That, from my perspective, it'll be forced to happen. Now, there are a lot of players out there in the space today. It's, of course, you got, on the crypto side, you got Bitcoin, Ethereum. Then you've got some coins that are, may or may not be the right coin. Maybe they're based on hype. But we're going to start to see value brought into the system. We're going to see these systems that are loyalty-based, that are based on effort, based on time, right? You're going to see these time-based environments, time-based tokens like Tempest come out, and they're going to come out very soon.
Thanks. So, Adrian, what are your thoughts?
First, I will say that, and this is the highest risk here, we can have all the time more opportunities to make money, to develop things, but we can't make more time. So the time we are spending on the project, betting on that future when something will happen, so delaying the gratification is a huge risk, because we can spend 3, 4, 5 years in something which will collapse before the gratification moment to come, and this is the biggest risk. How do you manage this risk? By first by pivoting, because if the team is good, it doesn't matter if the project will fail, because if the team will find ways to pivot that project. Is a famous book by John Collins, I believe. It's about excellent companies. So before anything else, an extraordinary team is needed. If that team is extraordinary, and if you are part of the extraordinary team, you will be able to transform a wreck in a successful project, no matter what happens in the market. If you will lack funding, you will get investors because they will bet on the team, and so on. So you don't need to be carried by the wave. It's not just about the equity; it's about the quality of the equity in which company you have your stake, or in each group of companies. So you need to do your own diligence, and of course to play your own role. It was a famous case with it was a blogging platform, Tumblr. When Tumblr was sold, the office manager of that company received $300,000, but that office manager was in the company for about 5 to 7 years. So this was like a happy story. But you will never know how the future will look. You just need to improve yourself, because the markets are changing, the technologies are changing, and no matter what happens around you, you need to invest in yourself, because all the change and all the nice future you are will start from inside. Everything else is a result. This is a little bit from personal development, a personal development angle. All the change comes from within. Everything which is outside of you, the successes and the failures, are results of things happening in the past. You can change the past, You can only work on the present and slowly on changing the future.
Thanks, Adrian. It's interesting the difference between what Gary and you said. Obviously, we're talking about the value in a token from Gary, and now you're talking about the value within yourself. One of the earliest tips I learned with investing is you always start with the team first. Focus on the team in charge, because they'll be able to weather the storm if the product isn't working correctly. Raghu, we're moving towards a new financial system. What's your thoughts on it? And, what would be on your wish list for it?
Yeah, I would prefer the type of things we're talking about, loyalty-based and, performance-based type of things kicking in. But initially, everything starts with an idea, right? And how to take it forward and the execution. So execution obviously needs to be compensated for the people who start the ideas and can carry them forward, because the leadership required at different stages of companies is very different, as I think Peter pointed out, and the compensation will also be different. And that means that the initial, founders will get diluted, but depending on how well they've thought through their model, will to some extent decide how much dilution they happen and how much leadership they can continue to give in the company and be relevant, right? For the longer you're relevant, the more likely that, you'll be less diluted. So it's not all about how much you have, but it's also how you are able to evolve through the different stages of the company as it matures. Of course, there are exceptions, the so-called hyper-growth unicorns, and some, where things happen like within a year. And but that is, I think, more of, as Gary rightly pointed out, that's not the norm. It's the exception. There are so many. For every unicorn, there is probably 100 that fail, which we don't hear about. So it's all nice to motivate yourself using those, but the real in the real world, you have to have not just the, there's financial capital is only one component. There is human capital, there is intellectual capital. All of them are important in the, the ultimate offering of the company and the valuation. So I think it's balance is what it means ultimately. And the leaders who are successful have that mix in the team, that it's not just too visionary or just too much on execution. It needs to have a balance for it to create value.
Thank you, Raghu. It's really interesting what you've said. It got me thinking actually about the different stages that we operate within business as well. We have wartime versus peacetime CEOs. Peter, you deal with a big family fund. Are we moving into wartime or peacetime within the new financial system? And how do you think we can operate in an agile way moving forward?
Listen, that's a great question, Luke, and I got to reiterate Raghu's comments. Look, we're in a new world in the pandemic, and hopefully there's more inclusiveness, there's more social responsibility, and people are more environmentally friendly, and there's obviously a much more friendly approach to the way people do business, and there's more empathy. One of the things that I love about what Gary and his partner are doing with GSD Labs are finding ways through mediums such as this on VCTV and LaToken to reach out to entrepreneurs in the developing world that wouldn't have otherwise access to a Raghu and Adrian, a Gary, and have access to them as mentors, rabbis, as capital providers, or their capital providers of people they work with that they wouldn't otherwise have had. And if it wasn't for the pandemic, which provided a blessing in disguise, we wouldn't be having these Zoom chats as frequently. People wouldn't have the time. It'd be very hard to reach out to an Adrian, Raghu, or Gary, or myself to find capital. So people have taken the time out during this pandemic to provide access that they wouldn't otherwise have. And I think that's a very important distinction and something really important in terms of humankind trying to reach out to their brothers and sisters. That being said, I don't get paid to be a philanthropist. I get paid for the capital I'm putting forward and the reward for the risk that I'm taking. So I'm just going to be blunt afterwards. So what's very important to me as an investor, and I'm different than an equity investor. I'm not a venture capital investor where I'm looking for huge amounts of upside And if it works out, great. If it doesn't, go on to the next thing. I don't have that ability. I'm protecting the multi-generational wealth of a family office or for several families. So we got to make sure that great-great-grandchildren are taken care of. So that basically means we're a bit of a bond investor. We want to make sure our capital is protected, but we also want the big upside. You obviously can't have your cake and eat it too. So we have to manage that risk reward. But one thing that I learned when I was a credit analyst and had pimples all over my face when I graduated school in the 80s and just started out at JP Morgan and then Sullivan Brothers was this: management. Adrian mentioned that. Okay. The management that you invest in, okay, and that team is what's going to lead to value going forward. Now, you can invest in a company that has a one product pony. And if that company fails because of that product, if that team can go and create another product within the same framework, then investors could be rewarded. If they take their team and go to another company, the investors are screwed because they only invested in the particular company. But management is key. You can have the best companies in the world, Apple and others, okay? And all of a sudden management sucks, or management isn't ESG compliant, or management hid some things in the accounts. The reality is that company goes bankrupt at some point. Maybe not initially, but at some point. Management is the key. And that goes to corporate governance. So we talk about ESG. What is the G? It's corporate governance. Okay. That is the most critical variable in the analysis of any company, whether it's a startup and you're getting angel capital in, or it's an existing and established company. Who's the management team, and can you trust that management team? And can the employees that are looking up to that leadership team and trust them? Because at the end of the day, they're working 12, 24 hours a day for these people, 7 days a week in many cases, that they're going to take them on their journey and there'll be rewards at the end. So that management team is key, and the team surrounding that is key. So I always invest in a team in any particular investment that I take a look at. That's the most important aspect.
Thanks, Peter. It's really, really interesting conversation. We started out looking at, is equity the new currency? We've done a complete round robin, and what we've realized is that the real value within a business is within the people. So, this is off script, but one last question to you all, is skill the new currency? Are people the new currency? Open forum. What do you think?
Well, I mean, that's what we're talking about when we talk about tokenization, right? It's the value. And so, yeah, sure, skill's a new currency, and also time's the currency, right? What kind of time you put in. So, I mean, it's going to shift. Our entire system's going to shift. We're going through that now. We're going through a metamorphosis. We're going from a caterpillar, hopefully, to a butterfly, right? And so, let's just hope there are no bats around to grab us, right? But
True that.
So, I mean, we're going through this metamorphosis, and as we're going through it, it's not going to be easy. It may not be fun, but it's needed because we got to, as I said, level the playing field. Think about this: with all the digital transformation it's taken and all the data that's around us, we each got to share in this planet. We got a lot to do on this planet to make it a better place. The population will go from 8 billion to 13 billion by the end of the century. By 2050, we're going to have to double the food supply in order to feed everybody. At the same time, 26% of the pollution is created by livestock. So we got to come up with new ways to be able to make this planet right. At the same time, the average temperature of the planet Earth could go up 8.6 degrees Fahrenheit by the end of the century. That means the polar ice cap melts. And in some places, the sea level could raise 7 feet, right? 7.4, 7.5 feet, maybe more. So we've got a lot to be able to do, and we need to work together. So with these types of tokens, with these types of cryptocurrencies, with equity, it'll bring us all into the same game, all be able to play together on the same field to be able to make a dent in the universe, as Steve Jobs said. And it's really important for humanity that we do that. And we don't wait to the future and just talk about it, that we start to act now.
I agree with your sentiments 100%, Gary. 100%. I was brought up, 20 years ago talking about this, and it's really nice that the conversation has come around full circle. and now we're dealing with this as a #1 priority. Yeah, no, thank you. Has anyone got anything they'd like to add before we round up?
Yeah, I do. I mean, look, I agree completely with Gary, and we sit on a lot of panels. We have business together, but the reality is an investor, whether it's in Gary's company, it's a family office like my investing. At the end of the day, that's great, and we want to see those improvements to humanity. But I'm putting capital out. That's either my personal capital, it's my company's capital, or it's the families. So all I care about is the return that I'm going to get over the next year. End of story. Everything else is just fluff. Okay. And by the time the turn of the century comes, I'm going to be dead. Problem is, I got so many kids, that 6 that I know about. So, I got to look out for them. But in all seriousness, I think that's extremely important. But the question that you asked was about skill. Okay. I come from Wall Street. That's where I was brought up on. Okay. And they didn't care about what your race was, your religion, your sexual orientation. It's a meritocracy. You could be 20 years old, right out of college with pimples on your face, and you could be making millions a year. What value do you contribute through the skills that you have honed? Okay. So your skills are the most important thing in terms of a global economy that's basically leveling the playing field for developing countries to developed countries. Okay, assuming that people have access to the education and the opportunities. And I think LaToken VCTV brings the opportunity for people that wouldn't otherwise have that access to people like the people on this show. But again, outside of luck, that skill is going to be important. And as I said to my kids, they're just entering the workforce, and they lived in a little bubble in New York City on the Upper West Side, and surrounded by billionaire hedge fund managers, etc. The reality is coming out of their bubble now. Okay, now they're competing on a global stage, and they're nobody. Okay, they're no better than anybody. Nobody cares about where their background is, where they went to school, private or public. What can they contribute? And if they can't contribute, they're out. There's somebody else to take their place. And so I think that has become more and more important. The skills that are brought, but obviously there's got to be a sense of humanity to it, and people need to work as a part of a team. But it's become that much more important that I think the playing field's level. Nobody's better than anybody else. Now, I know that the new generation, because I have little kids from 3 years on old, always up to 20s, and my kids that are in their 20s and millennials, call them snowflakes, they're supposed to get, if they lose in a team sport, they're supposed to get a trophy just because everybody's supposed to do well. No, that's not how the world works. You're either a winner or you're a loser. There's nothing in between. You have a company, it's either a winner or it's a loser. There is nothing in between. The rest is mediocrity. Okay? And so you got to reward skills and people that contribute to the team. End of story. And that will be rewarded and reflected in the share price. End of story. Financial markets are extremely efficient. Capitalism works. That's it.
Yeah, I wanted to add a couple of thoughts to that. I mean, skills, and I think the second thing that, skills, it also depends on what type of skills and the adaptability of skills, because things are changing so fast. It's not enough to kind of get a degree and then you're done. It's lifelong adaptability. So that's one piece. The other piece,
I don't even know how to use my phone. I still use yellow notepad. So,
well,
I'm
you're trading your wisdom. What you have is wisdom from the skill, right? So that connection. So that's what's my second piece. It's about your emotional intelligence, about relationships. It's not just skill is one piece, and the relationship, the emotional intelligence you need, because it's not about there are only few things you can do just sitting back at home, right? So that's why this social. See, rather than having things like a social credit score, like the way like China is doing, it needs to be based on loyalty and performance. I mean, the same thing has happened, but based on democratization, not based on authoritarianism. So it's just a flipped up model, right? And the second piece is the data, because of the evolving towards artificial intelligence. The product companies especially needs to have accessibility to their own data, because data is kind of what is needed. It's not enough that you have the best technology if you cannot train it with the right data. Again, the social bias and all this stuff come in. So data is very key along with the skills.
Thanks, Raghu. Adrian, have you got any closing statements for us?
Yes, I have an idea. There are articles lately about people working from home and dabbling between two full-time jobs using two laptops. And when they have a call in the same time, they actually say to one job, okay, I have connectivity problems, I can't be online. And this is a flaw in the old way of being employed, because this is based on the number of hours you have to work, not on the objectives you have to reach. And basically, it's the work of the HR manager to assess very well every employee and to say, okay, in 1 week you have these objectives. If you are productive like crazy and you have a second, a third job, it's up to you. Just at the end of the week, this needs to be achieved, because we as a company will have a return on investment on the money we are paying you. The objectives are met. We are very happy. No frustrations. Everything is cool. It's a paradigm change in this respect. The work market is changing, and usually the most valuable people are too valuable to be employed by just one company. They can have, I don't know, 1-2 full-time roles. They can be advisors. They can be investors with smart money in some other projects. They can work for NGOs to contribute their time, as it is the Virgin Startups program in UK, where you are contributing your time to help startups from the first day in business, and so on. And it's always, and everything is based by the value you can provide, by the contribution you can make, because at the end of the days, only these things matter. Everything else is just noise.
Thanks. I feel like we could continue this conversation all afternoon.
Forever. Or 1 weekend at least.
all weekend.
In shifts.
I know you guys are super busy. So I'm going to round it up there. I'd just like to thank you so much for your time this afternoon, and for a really thought-provoking interview. Thank you. It's my first one. I hope you've enjoyed it as much as I have. And I look forward to meeting you again. Thank you to everyone who's viewed this today. If you do have any questions, please pop them in the comments section, and we'll be in touch. But Raghu, Gary, Peter, Adrian, I wish you well. Thank you so much for your time today, and enjoy the rest of your afternoon.
All right. Bye-bye.
Thank you very much. Have a great day. Thank you.
Cheers, guys. Thank you.
Cheers. Bye-bye.
Bye-bye.